recording. It should come up with a, can you guys see my cursor when I move it? Probably not. You probably won't see it until I'm sharing. Okay. So do you guys see the banner that says you're recording?
Yes. Yeah.
Okay. So that's what I need you guys to look for. Okay. I will try to remember to do it as class starts every time, but if you guys look up there and it's not recording, please say something to me. Because I hate to have to go back and do this again to an empty class for the people who are online students. It's no fun. Okay, so I'm sharing. Can you guys see the introduction to management accounting slide? Okay, so let's get rocking and rolling into the actual classroom portion of this stuff. Okay, that's the book. So this class is broken into learning objectives. If you look at the first page of chapter 1, you should see a list of learning objectives, right? Okay. And then just below that, where it starts into the stuff, you should see learning objective 1 and a little blue dot or a little blue square next to it. Is that correct? Okay. So as we go through this, the way I've got these slides laid out is they kind of match up with the learning objectives. So if we're going through a slide or you're reading the textbook and you're like, okay, I know I heard Dave talk about this. So you match up the learning objectives in the book with the learning objectives for the slides, and it'll help you guys as you're trying to track along where my slides match up with the textbook, okay? So management accountability. As managers, we find ourselves accountable to a lot of different folks, okay? We're accountable to our suppliers, to our owners, to government, to creditors, and to customers. Now, to our owners, that's pretty straightforward, isn't it? How we're accountable to our owners. I mean, you know, they own the company, they supply the resources, and as managers, we're accountable to them. Pretty straightforward for making sure that that we're giving them a return on their investment. Okay, and government, yeah, that's pretty straightforward as well. Because the government has laws and regulations, and we're accountable to live by those laws and regulations. Creditors, again, that one's pretty straightforward. If the creditors are loaning the owner money, the creditors want a good return on their money, okay? So that's pretty straightforward. But suppliers and customers, as managers, how are we responsible to our suppliers and our customers? Well, our suppliers, they're in business as well. And they're in business. If you're in business, why do we go in business, y'all? Somebody tell me, why we go in business? Come on.
To produce something, make a profit.
There you go, to make a profit. I mean, if we're now, some businesses are nonprofit businesses, and they're more specifically for service. But the reality is, we go into business to make money, right? So if and you guys are going to hear me refer to machine shops a lot, because other than my time in the military, machine shops is what I have the most experience in. But either machine shops or my trucking company. Okay, so I'm going to refer to them a lot because that's the experience that I can draw on to give you guys examples. But in my machine shops, I had suppliers that were supplying me raw material, metal, that we would put on the lathes and cut up in different ways in order to make different products that we would then sell to Exxon and different folks that were drilling for oil. That was the business that I was in. So I had suppliers that would supply material to me. Well, the way I'm accountable to those suppliers is, as I order that material, first off, I have to be prepared to receive it and do something with it. But I also have to be accountable to them. Once they've delivered that material, they expect a return on their money. So they expect payment in a timely manner. And if my agreement is there's a term that you guys will run into in business that's called net plus 30 or net plus 60. And that means basically from the time it's delivered, I either have 30 days or 60 days in which to pay the invoice. Most companies operate on a net 30 business. There are some companies, though, that operate on a net 60 business, because depending on how they do their accounts payable, they may only do their accounts payable once every 45 days. The government, if you're doing business with the government, you have to have a net 60 business because they only pay their bills every 45 days. Never understood that, but that's the way the government operates. Most businesses, though, if I get something delivered on the 25th of August, by the 25th of September, I should have paid that bill. Some businesses pay their bills once a week. Some businesses pay their bills once a month. And that's the reason for the net 30 in most business circles. Okay? So you guys can see how we're accountable to our suppliers and to the government, owner, and creditors. How do you guys think we might be accountable as managers? We're accountable to our customers. We think the biggest two issues would be as far as us being accountable to our customers.
They're looking to buy your product, so it needs to be acceptable from you.
It's got to be accessible. They got to be able to get to it. What do you think the other primary thing would be?
They're expecting it to be available.
I would kind of lump that in that accessibility as well. You know, how do they get to it? Whether they find it in a store, whether they find it in a catalog, whether it's over the phone, they're ordering it. But the other big thing is quality. They're expecting me to supply them with a quality product, wouldn't you think? I mean, if you guys are Exxon and you're buying a drill that's supposed to go down in the ground and drill through limestone rock, and I give you a drill that won't drill through sand, I haven't given you a quality product, right?
Exactly.
So that's kind of the other, accountability piece to it there, as we talk about how we're accountable to our customers. Okay. This basically is the same information as that last slide. It's just kind of done in a different format, and I've tried to do that on a number of slides we do. But so for our suppliers, we're providing a product or a service, and using the goods and service to earn a profit. So management's accountable to our suppliers to pay our bills and to use the goods and services they're providing us. Okay, where management is accountable to our employees. Now, this one wasn't on the first chart, but they're providing their time and expertise, and we're accountable to them to supply a safe and productive work environment. Okay, so it's kind of the same chart, just a couple of different things added to it. Okay, and this is just two slides of that information. All right, so I don't remember whether there's questions about this stuff specifically in the homework assignment for this week, but these are some things that you guys just need to. It's once you've looked at it, you're going to think, yeah, that's common sense, okay? But if you haven't ever thought about it before, it may not be common sense if it's just not something that's ever been in your train of thought. Okay. So what is financial accounting versus management accounting? Okay. Financial accounting, that's the stuff on that left-hand side. And we're going to kind of run down that real quick. So financial accounting is an external reporting. The statements that come out for audit statements, the profit and loss statement that shows to our creditors, to the people at the bank. If we're a publicly held company, to the people that are thinking about buying stock in our company. Maybe if we're trying to sell the company, those documents that a buyer would look at to see, is this company profitable? Is this company something that I want to buy? Okay, so it's external stuff. Okay. It provides financial statements and to external stockholders, like we were just talking about. It satisfies management's accountability both to the owners and creditors, to the regulatory agencies. That's a nice fancy way of saying the government. Okay. Whereas on management accounting, if you look on the other side, that's internal things, like your financial accounting is never going to show cost of goods sold, where the managerial accounting will, because cost of goods sold is something that we use internal in the company to make sure that we're hitting our targets so that we are in fact profitable. Okay, it gives us key information to be able to plan with, to know how we're doing and what we're looking at as far as when we start to look at what we're going to do in the future, when we're forward looking, making our plans. All right, so just kind of make sure you understand the difference between financial accounting and managerial accounting. Financial is external, what people outside the company are going to see, where managerial accounting is internal, and those calculations and documents and stuff that we need in order to be able to plan as managers. Okay, here again, another one of those things where it kind of takes the same information. So the primary user, okay, so you think this column, is it financial accounting or is it managerial accounting? Well, who's the primary user? For managerial accounting, it's company managers. For financial accounting, it's creditors and investors. So if we're doing something that shows the purpose for the information, to help managers plan and control operations versus to help investors and creditors make decisions whether they want to invest in the company. Okay, so if you kind of look down here and see, what are we talking about? The type of reports: internal reports, not needed for audit. Okay, here's a term that you guys are going to need to be familiar with: GAAP. And that's generally accepted accounting principles. Okay, when we're talking about GAAP, 95% of the time, when we're talking about GAAP, we're talking about financial reporting. It's the stuff that the auditors and creditors want to see. Okay, that pretty much covers learning objective 1. Okay, what is managerial accounting? And how does it kind of differ from financial accounting? All right, you get into when you get into accounting and you get into like the stuff that the bank does and all of that, that's a financial accounting. It's a whole totally different process. Now the principles are a lot the same, but it's a different process. Okay, so learning objectives 2, to identify different trends in the business environment and the role for management accountability. So what's happening in the business world and why is it important to what we're learning here? Okay, trends in today's business. Okay, there's been a shift toward service economy. And you guys are all young enough that you probably don't remember the days when industry and manufacturing was the king of all business here in the United States. It still is key and critical in the United States, but it's not everything like it used to be. Now we're much more towards a service industry. The hospitality industry has always been service, as far as hotels and movies and dining and all of that stuff. But the reality is, so much of what we do today, and I left my phone in the other room, but so much of what we do today is done on our phones. Okay, an excellent example of a service industry is Amazon. They provide us a service. Well, 20 years ago, Amazon really didn't exist. I mean, they were around 20 years ago, but not nowhere near what they are today. Okay, they were a fledgling company just getting started 20 years ago. Now they have like 40% of the market share of stuff sold today. As a result of Amazon, now Amazon has a lot of stuff that they deliver themselves, but as a result of Amazon, FedEx and UPS have gotten a lot bigger than they used to be. Because not only are we buying stuff from Amazon now, but now we're buying stuff directly from Walmart and Lowe's, and we can have it shipped directly to our house. Well, all of those other service providers are now using FedEx and UPS and DHL to deliver those products to us that we didn't used to be we had to go to the store and get them. So that's a whole nother service industry that has developed fairly recently. I mean, again, they've been around for more than 20 years, but they've just exploded over the last 20 years. Global competition. Used to be that everything we needed or wanted was pretty much made here in the United States. Now when you buy something, it's more likely made in Taiwan or Korea or China. So it's a global industry. You know, oil and gas initially started out here in the States with the oil boom back in the 20s and 30s, and then it shifted to in the 60s and 70s. It shifted over to the Middle East and the OPEC nations, and then for a while here in the 90s and the 2000s, it shifted back to the United States. And so, I mean, it's a fluid market, and the reality is when you buy a gallon of gas anymore, you don't know if the oil that produced that gas came from Texas or from Saudi Arabia, because the oil companies are multinational as well. They don't just have offices in all those other countries. They have presence there, and that's where they do business. Time-based competition. So advances in information system. I mean, come on. How many are any of you guys space buffs as far as, like, you know, men going to the moon and that kind of stuff? No? Oh, well, I guess that's my generation more. But when we sent the first guys to go land on the moon, okay, Neil Armstrong, the computers that were in his space capsule, most of the computers that were in his space capsule would fit in a cubicle that was 3 foot by 3 foot by 3. It was a 3 foot cube. So, you know, nice big computers. And that space capsule had 7 of them, so that it had redundancy in everything that was happening. Okay, so that this computer failed, the same process could have been done by a different computer. It had 7 of them. Now, not all 7 of them were doing the same thing, but every computer that was in there had one of those other 6 computers had a backup to whatever was happening on, you know, this computer. Now, one of you hold your phone up for me. Okay. You see that phone? There's more computing power in that phone today than all 7 of the computers that was on the Freedom spaceship that landed on the moon with Neil Armstrong. So we have gone, our advances in information systems and technology is crazy. Our miniaturization has gone crazy. Okay, so that's trends in our business today. And I think it's going to go even more so in the next 20 years, because you've got not just the government now going into space. Now you got private businesses going into space. You got Elon Musk and all those other richety rich dudes. And the technologies that they're having to develop in order to be able to do that is crazy. E-commerce, we kind of hit on that a little bit, talking about Amazon FedEx and those guys. So we've gone much more to an e-commerce based economy. Just-in-time management, okay? This is one of those things that in one of my other classes that some of you may take, you're going to get this a whole lot more. But one of the things that we're doing in management now, instead of having big warehouses of finished goods that are sitting ready to go fill an order, or instead of, like when I ran the machine shop, instead of me making 500 of an item and putting it on the shelf so that somebody could come in and order 20 here and 20 there and 20 there until all 500 were used up. What we ended up doing was waiting until we got the order for the 20, and when we would make them, we would make the 20. Now we may make 25, and I could put 5 in the warehouse so that then when the next order came in, if somebody came in and said, look, I need 20, but I need 3 or 4 of them like yesterday, I could have 5 of them sitting on the shelf that I could issue him while I made the rest of his order. And then I would ship that stuff out. So I would usually keep a little bit of a reserve so that if one of my customers came to me and needed something right now, I could provide it. That's a good service. But I wasn't keeping enough on the shelf to fill the full order. I would fill the order just in time as they needed it. That allowed them to not have to store a whole bunch, because if they needed 20 of these items, but they're going to use those 20 items over the next, 2.5 years, well, they don't need all 20 of them on day one. A lot of times they only needed 2 of them on day one. And then every 6 months, they would replace those 2 with another set, or however their process works. Well, instead of ordering all 20 of them up front, they would order 20 and say, I need you to produce these at a rate of 5 a month and deliver them as you produce them. Okay, same thing with my suppliers. Well, if I don't have to make all 20 of them at one time, then I didn't have to bring in all the material to make all 20 of them at one time either. So I wasn't storing a whole bunch of raw material sitting out in a warehouse somewhere, just waiting on somebody to go get it and stick it on a machine. So that's what we call just-in-time management. We're bringing in supplies just in time for us to put it into production so that we're done producing it just in time to meet our customers' needs. That's the way business is going today. And in total quality management, that gets us into what's the term I'm looking for? The inspection process and quality management control. Okay. And total quality management just gets us to a point where we talk about managing the quality of the product from the beginning to the end. We're making sure that the raw materials that come in are the quality and the right needed materials in order to make the product that we're making. If we're doing concrete, that we're not using substandard concrete. If I'm building a machine for Exxon and it requires a certain amount of lead and copper and zinc in the metal, that metal has been tested and it meets those standards. Okay, and then as we're machining it, I've got inspectors that are checking the machine work to make sure that it's the right size and meets the right tolerances so that when the product is done, I can sell it, as opposed to waiting until the very end when I do a quality control inspection and I find out, oh, I can't sell this now because a problem back on step 2 caused everything else to not work. Whereas if I had caught that problem back on step 2, I wouldn't have invested all that time, effort, and payroll into paying people to do those other 5 steps. We could have stopped, gotten more material, and gone through step 1 and step 2 again, and then finished it. So that's the total quality management concept. And again, when we get into some of the other business classes, we get into that much more detailed. Okay? And again, that's learning objective 2. Not, what are the trends in business today? That the whole slide. Okay? So learning objective 3, classifying costs and preparing income statements for a service company. Okay? So what we're going to do is, so we're going to talk about a service company first. So you guys give me Every one of you needs to give me an example of a service company that provides a service.
A funeral director.
Say that again.
A funeral director.
Okay. You guys, and the reason I had to have you say it again is that microphone, when you guys don't say anything for a while, it kind of goes into a standby mode. So a funeral director, very much so, they provide a service. Okay. They're not providing a product. Okay. They're not merchandising anything. They're providing a service. So give me another example of a service company. Go ahead, Owen.
Valvoline Oil, they change your oil for you.
Okay, so the oil company, as far as where you go to get the oil changed in your vehicle, yes, they have some products, just like actually the funeral director does. He's selling caskets and stuff, but the Valvoline Oil Company, you go to get your oil changed, so they're providing you a service to change your oil. Okay, ladies, you guys got some other examples?
Like a taxi service?
Taxi service, perfect.
Or like a
Lyft. All of those guys, they're providing you a service. You need to get from point A to point B, and you don't want to walk, so they're going to drive you.
Oh, a plumber?
A plumber, there you go. So, and that works. I mean, yeah. When you need a plumber, you need a plumber. You don't want the sewer water backing up in the bathroom or in the kitchen sink. Okay. The first one that always comes to my mind when I think of a service company is Verizon. My telephone service. I don't know why it does, but when I think of a service company, you're saying the coffee maker, huh?
No, it has T-Mobile on it.
Oh, does it?
Yeah, you can see that. Yeah.
But whether it's T-Mobile or Verizon, the companies, I mean, because I have that stupid phone in my hand half the day most of the time. Either that or I'm doing this on a computer. So my eyeballs get tired of looking at electronic screens after a while. So those are examples of service companies. So how do we classify the costs that are involved with a service company? Okay, because the company has costs that they have to deal with, right? Well, let's see if I can make this slide work. Okay, so in a service company, service company is going to seek to provide a service. It's a high quality service, at reasonable prices, timely delivery. That's the things that they do in order to stay in business, right? That reasonable price, that's very subjective, okay? Because some people will say the cost that they're charging for their service is way too high and won't use them, and other people say, well, that cost is just right. So it's a very subjective thing. It's kind of the simplest accounting that we do because there's really no inventory. Now, in a couple of the examples, like the funeral home director, yeah, he's got an inventory in that most of the time he's going to put that body in a casket, okay? Or the Valvoline oil change place, they're going to have oil, so they're going to have inventory. But for the most part, the services, there's not a lot of inventory that we have to account for, okay? Even the plumber sometimes will have inventory because he gets to your house and it's better for him to have some stuff on his truck so he doesn't have to run to the store every time in the middle of doing a job. But little to no inventory, okay? The Lyft guy or the taxi guy, that's kind of the best example of no inventory. Now, he has costs to do business, okay? Because he's got to pay for his car, and he's got to pay for his insurance, and he's got to pay for his fuel. But there's no product that's passing from him to you. Okay, that is a straight up total service. Okay, and now here's where we start getting into these accounting terms. Okay, so all the costs are period costs, and a period cost is defined as in we account for it and we bill it on our statement in the same period in which it happens. Meaning, if I have a cost, and let's go back to the taxi or the Uber driver, okay? That Uber driver has a car payment that he has to make each month. Well, in the month of September, if he has a car payment, he's going to pay it. We're going to charge that car payment for the month of September in the month of September. If he has to go buy fuel, and hopefully he's driving enough, he has to buy 2 or 3 tanks of fuel. But if he's got to go buy fuel, the fuel that he buys in the month of September, we charge in the month of September. We don't charge it in October or November, we charge it in September. So it's a period cost. The period in which it happens is where we charge it. So you guys got that definition? Understand what a period cost is, right? So how are we going to figure this out? Well, our net income is our revenues minus our expenses. Pretty straightforward, right? If the Uber driver's made $1,000 that month, that's his revenues. If his expenses that month were $400 for a car payment and $68 for insurance and another $200 for fuel. Now, mind you, I'm just pulling these numbers off the top of my head, guys. Okay. Well, he made $1,000 and he had $600 for his car payment, $200 for his fuel, and $68 for his insurance. So his expenses for that month were $868. He made $1,000. So as far as his profit, which is just simply, or his net income, which is his revenues minus his expenses, how much has he got? Well, he's got $32 left. He didn't make a whole lot of money in that month. If you go with those numbers that I pulled out. So let's see what I got here. No cost of goods sold. Okay, and that's a straight up service only industry. Now, if we go back to the oil change, like Owen said, there's going to be a cost of goods sold there because there's going to be, if he's changing, if Owen's changing my oil, or he's going to a company that's changing oil, there is some inventory involved there, okay? Because there's oil that's got to go back in the car. But in a straight up service only industry, and taxi or Uber is probably one of the best examples that I've heard in a long time. Yay! There's no goods changing hands, okay? So that's how we do a service company. It's the simplest. Our net income is our revenues minus our expenses. Can you guys see the cursor now?
We can.
Okay, so when I'm on my slide, you can see the cursor. Okay. Good, because I tend to point, if I'm in the classroom, I'm usually standing up and I got a pencil and I'm pointing at the screen. So I'm glad you can see the cursor. So our net income is revenues minus expenses. Straightforward, slam dunk, if you will. Okay. So now we're going to go to a merchandising company. Okay. Now a merchandising company is a company who they don't make it. They buy it, they inventory it, they sell it to you, okay? All they're doing is a merchandising company. Can you guys think of a couple examples of a merchandising company?
A clothing boutique.
Clothing boutique. Somebody give me another one.
Walmart.
Walmart, there you go. Walmart doesn't make nothing, okay? But they sure sell an awful lot of stuff, don't they? Okay, so let's think about how we are going to account for the stuff that Walmart or a clothing boutique. And when I think clothing boutique, the first thing that comes to my mind, because my grandkids love to go there, is Claire's in the mall. Claire's doesn't make anything, but they sure sell an awful lot of junk. At least to me, it's junk. Okay, so a merchandising company. They resell products purchased from suppliers. Okay, so Claire's or Walmart, they purchase stuff from suppliers, they put it on the shelf, and they resell it to you. Okay, they do have to keep an inventory of their products. and their cost of goods sold is their major expense. Okay, they're going to have some other expenses because they're going to have some payroll because somebody's got to be there to do the selling. But their major expense is the stuff that they buy, how much do they buy it for, versus the stuff they sell, how much do they sell it for? Okay. Product cost flow through inventory. Now here's that GAAP term again. Okay, GAAP requires companies to record inventoriable products cost as an asset until sold. So what that means is this, where we were talking about period costs before. Okay, in a service company, everything is a period cost. Whenever it occurs, boom, it gets billed. Okay, but let's go to Walmart as a good example. When I moved down here to Texas, I went to Walmart and I bought this huge smoker pellet grill. Okay, now Walmart may have bought that pellet grill because this is one of the big ones that they don't sell as many of. So they may have bought that thing back in January or February to get ready for the summer grilling season. So if they bought it in January, then GAAP says they have to hold it on their books as an asset, meaning they now own it and it's something they can sell, but they haven't sold it yet. So it's an asset sitting there waiting to be sold. And so they bought it in January, so they held it in February and March and April and May and June. And when I bought it on the 1st of July, now they've sold it. So now it can be calculated in their cost of goods sold because now it's actually been sold. So it has to sit on their books as an asset until they actually sell it. Once they sell it, then it goes into their cost of goods sold calculation. Does that make sense? Somewhat, maybe? Clear as Mississippi mud?
Yeah.
Okay. So how do we do their calculations? Okay, product cost. So our beginning inventory, and again, in going back to the example of that grill, our beginning inventory is how much did we have when this accounting period started? So in January, if Walmart bought that grill in January, they didn't have it on the 1st of January when they bought it, right? So they didn't have any. Okay. So plus the purchases. So they bought that grill. So now they've got some because they purchased it during that period. And they had some freight expenses. So they had some freight expenses that came in. Less the ending inventory. Well, at the end of February, they hadn't sold it yet. Okay. So that is in their ending inventory. So that goes to the cost of goods sold. Okay. Now, that's a very, 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 very simplistic view of it because the reality is Walmart probably bought 500 of those grills and they went to different stores and they may have actually had somebody in there in January that bought one of those. Okay, because living in Texas, you can grill down here and well, I grill up in Missouri in January too, but that's just because I like grilling all year round. Okay. So but what I was giving you is a very simplistic view of it, okay? And we're going to get into some more, looking at some more here in a little bit, but it's how much did I have in my inventory to begin with? How much did I purchase? Oh, by the way, when I purchased it, I had to get it to my place of business, so I had to pay for freight coming in. How much do I have left over at the end of the time? So the difference is because here, let me see if I can pull one off the top of my head and make it work. So let's say I'm selling tennis shoes, okay, and I had 100 tennis shoes in my store, that clothing boutique. I had 100 pairs of tennis shoes in my store at the 1st of March, and I purchased another 100 sets of shoes during the month of March. So now I've got 200 shoes. I had some freight costs that were involved with that. Okay. At the end of the month, I have 150 pairs of shoes left over. Well, if I had 100 and bought 100, that means some point through the month I sold 50 pairs of shoes. Okay. So whatever and when we say beginning inventory, we're not really so much worried about a piece count. We're talking about a dollar value. What was the value of those 100 pairs of shoes that I had? How much did I have to pay for those 200 pairs of shoes that I bought? Because I may have had 100 pairs of shoes, but they may not have all cost me the same amount per pair, because I may have had 5 different kinds of tennis shoes. Make sense? So we're talking a dollar value on the beginning inventory. How much was the value of my beginning inventory? How much did I buy? What was the value of that? How much did I pay in freight to get it there? What's the value of my closing inventory? So if I take this number plus this number plus this number minus this number, that's going to give me my cost of goods sold. All right, you guys tracking with me? Heads up and down? Okay. This is the point at which sometimes I start to get the deer in the headlight look, so I want to make sure you guys that I'm making sense. Okay. So product cost versus period cost, okay? And this is another one of those terms you need to be aware of. Product cost, it's part of inventory, and it stays part of inventory until it's sold, okay? Once it's sold, then it becomes part of our cost of goods sold. For a period cost, it's not part of inventory. And it's expensed when it occurs. Well, let's look at an example of how that would fall into place. Let's go back to Walmart. Walmart's got, let's say they got, in a store here in Killeen, Texas, they've got $1.5 million worth of inventory in their store. Okay, and they bought another $1 million worth of inventory during the course of the month. Well, now they got $2.5 million worth of inventory. And they sold $1 million worth of inventory during the course of the month. So now they're back down to $1.5 million in assets left over. So their expenses that month, okay, that is transferred to cost of goods sold during that month, okay? But they also have payroll that they have to pay, right? Remember I was telling you back when we first started talking about a merchandising company, they have other expenses. Well, payroll is what we call a period cost, because if you work during the month of July, you want to get paid during the month of July, right? You don't want to get paid during the month of January, do you? And no, I didn't think so. Okay. So you guys understand the difference there? The product cost is those things that get held as an asset. And this comes into play when we're talking about a merchandising company. It also comes into play when we're talking about a manufacturing company. Okay, so we will have product costs where we will buy material, and it is an asset until we've done whatever we're doing with it in our manufacturing process, and that material is ultimately then sold, and then it goes into our cost of goods sold. Now, when we get to that point, I'm going to throw another term at you. That's cost of goods sold, but then we also have cost of goods manufactured, and that's slightly different. Cost of goods manufactured is what was the cost to manufacture these goods versus what did we sell it for, and that gets into that revenues minus cost to give us our net income stuff. Okay, you guys like seriously bored out of your skull now, right? He's throwing terms at me I don't want to play with. Okay, so let's take an example, or let's look at an example. I know this is what you guys were really looking for. How do I take all that stuff you've said over the last hour and a half and put it into a spreadsheet and make it make sense, right? So, net revenues. So this is, okay. Okay, now this is a merchandising company. They don't build any of these brushes. They just simply sell them. So in their inventories, cost of goods sold, so their beginning inventory was $7,400. It's $704,000 worth of brushes. They purchased another $62,800 in brushes. And at the end of this period, they have 6,000 brushes left over. Okay. Well, what's our cost of goods sold? So if we have 7,400 in inventory beginning, we add 62,800 to it because that's what we bought during that period. And at the end of it, we've got $6,000 worth of stuff left over. So this plus this minus this gives us a total of $64,200 in our cost of goods sold. Okay. Well, ultimately, what we're trying to do is get to our net income, right? So we had this much money that we made selling the brushes that we sold. So we made this much money selling this much money, this much worth of brushes. So our gross profit, so this is our net revenue income. If this is our income and this is our expenses, our gross profit is $64,300. You guys see how we got that, right? Because you're going to have stuff like that in your homework exercise tonight. So if you take, this is how much money we made selling our brushes. We had this much worth of brush inventory to begin with. We added this much worth of brush inventory during the course of the month. At the end of the month, we had this much dollars worth of value left over. So if you add what we began with and what we purchased, subtract what we have left over, that's our expense for the month. This is how much the brushes cost us that we sold. Well, we sold them for this amount. So if we sold them for this amount and it cost us this amount, if I take this minus this is my gross profit for the month. Okay? So right? Remember I was talking about we got to pay the labor or the sales guy who's standing out on the floor at Walmart and the manager and we've got some other expenses. This is, you guys are going to hear another term, SG&A. Okay? Sales and this doesn't have the word general there, but sales and general administration. Okay, SG&A. And depending on the kind of company we're in, sometimes we break those out and have them very detailed. Sometimes we roll it all up together. So the selling, that's the people on, the cashier and the people on the floor selling stuff. The general administrative expenses goes to the manager for the store. Goes to the gas and the electric and everything in order to light the store and heat the store and all of those things that we have to do. So in order to figure out how much money this brush company made, they have to know, okay, well, my gross profit is my sales minus my expenses for the stuff that I sold. It gives me my gross profit. But then I also have to pay my salesman and I have to pay my electric bill and my gas bill and all of those other expenses that I have. So that's the SG&A. So my net income, how much I have left over once I pay all of my bills, is $18,900. Make sense now? Somewhat, maybe? Okay. I got four of you, so I need to see four heads, because if not, we'll slow down and we'll make sure you understand. That's kind of where I'm going with that. Okay? So just remember, now this is for a merchandising company. So the service company, the Uber driver, is just simply his revenues minus his expenses gives him his net income. Well, this is the same thing, same. You have categories of expenses. Your cost of goods sold is one category of expense, and your SG&A is another category of expense. So it's revenues minus expenses gives you your net income. Same formula, just a couple more steps in it. Okay? And this is, now, if you want to take this, and let's look at it in a flow chart. So our cost of goods sold divided by our, oh, let's see, hang on, this is the next step in it. How much does a single unit cost? Okay, so our cost of goods sold divided by how many we sold gives us our unit cost for one brush. So if you come back here and you look, we sold $64,200 worth of brushes. Okay, well, we know we sold 5,700 brushes. We don't know that until right now, but in your story problem in your book, it would have said we sold 5,700 brushes. You need to calculate how much did it cost us to sell one brush. Well, if our expenses, our cost of goods sold was $64,200, and you divide it by 5,700 brushes that we sold, it cost us $11.26 per brush. Now, we might have been selling those brushes for, $20 a brush, or $15 a brush, or $18 a brush. Okay, this isn't how much we sold them for. This is how much it cost us to do it. Okay, so the total cost divided by the number of times you did it gives you the cost per unit. And that's the end of learning objective 4. How do you do your cost for a merchandising company or a throughput company? You guys will. So now we're going to classify the cost for an income statement for a manufactured good. Okay, so now we're going to add another step to this. So now we're a company that buys material, and instead of just turning around and selling that material exactly like we bought it, now we're going to buy material and we're going to manufacture something. We're going to actually produce something, which is going to add expenses, right? Because you're going to have folks that are producing it, doing different things to it in order to make it what it needs to be going out the door. Because what it came in the door and what going out the door is two different things. So there's a production or a manufacturing process that happens. Okay, so we have our material inventory. What does our materials cost us? We have our work in progress inventory, stuff that's being worked on still. And then we have our finished goods inventory, stuff that we finished and is ready to sell. But remember what we said earlier, if we haven't sold it yet, it's still an asset. So it's a finished good inventory. Okay. So the use of labor, plant, supplies, facilities, to convert raw material. There's 3 kinds of inventory. So, this is a manufacturing company. Okay, so labor, materials, plants, all raw material to give us a final product. So our material inventory, work in progress, gives us our final inventory. Okay, the types of costs that we run into. So now we have another classification of cost. Now, before we were talking about a product cost and a period cost. Okay, now we're talking about direct cost and indirect cost. What's the difference? Well, the difference is a cost that can be traced directly to an object. Okay, so now my machine shop, that went down into the ground to drill for oil. If I could track a cost directly to that drill head, meaning the metal that I bought to make that drill head, and I may have bought 15 different pieces of metal because I had to make 15 different things that got pieced together in order to make that drill head going down in the ground. But all of that I can trace to this one drill head, then that is a direct cost, direct materials going into making this drill head. Okay. Direct labor, I can track directly, this machine has spent this many hours working on this part. This machine has spent this many hours, and this machine has spent, but I can track the hours that those machinists spent working on a specific part that's part of that drill head. So again, that's a direct labor cost. But then I've got some indirect costs that can't be tracked directly to that specific drill head, okay? And those are called manufacturing overhead. So let me give you some examples. And again, I'll use my machine shop because that's a reference that works for me. In my machine shop, I had 63 different machines, lathes, that would cut metal in order to make these parts. Well, with that many machines, I had to have a couple of mechanics on hand because those machines tend to break down. So if one of my lathes broke down, I had a mechanic that was there and he would fix, oh, you guys, they're cutting the grass behind you, huh?
Yep.
Tell Ben to go away, it's class time. Okay, here you go. Bang. You guys will find sometimes I chase rabbits, and when I do, I tend to shoot them so I can get back on track. So Ben and his grass cutting is a rabbit I just shot. Costs, right? So my machinists are a direct labor because they're directly making that part. But my mechanics were not direct labor because the mechanic, he might be working on this machine for an hour and a half. And then when he's done working on that machine, he goes and works on another machine that's making a totally different product. Well, unless I've got really detailed records on what machine he was working on and what was on that machine at the time, it's hard to track his labor directly to that drill head that we're talking about. So he goes into what's a category that's called manufacturing overhead because he's indirect labor. It's still labor I have to pay, and I have to account for the expense of his labor, but I can't track it to a specific job or a specific thing that I'm selling. So his labor is an indirect labor that goes into my manufacturing overhead. There's a few other folks that would typically, like my salary when I worked for this company, as a manager, my salary went into manufacturing overhead because I was supervising and the plant manager over a plant where we made 15 different things for this company. So my time wasn't charged specifically to each of those 15 things. Mine was an indirect labor cost. Or the lady who sat in the other building who processed the payroll. She didn't have anything to do with the manufacturing at all, period. The only thing she did was process payroll because those guys got paid once a week and they wanted paid every week. So her job was simply to process payroll. But I still had costs. Some other things that go into that manufacturing overhead or indirect costs would be, in this case, now before we were looking at the SG&A, that's sales and general administration. Well, now we're pulling some of those costs out of the SG&A and we're putting it in our manufacturing overhead. Okay, so now if I've got to pay rent on the building that we're in, you know, I'm renting this warehouse that we're working out of, and I've got utilities that I'm paying, not just the rent, but I'm also paying the electric bill and the gas bill and all of these other things. Now that can be left in SG&A, and some companies do, but a lot of times if you were talking about a manufacturing company, now those types of expenses get moved into our manufacturing overhead costs because I have to pay those every month. There are period costs within the manufacturing process, and I have to pay those every month. However, if I don't account for my rent and my gas and my electric, when I'm trying to figure out what it costs me to make one of those drill heads, then I'm not, if I'm only looking at the direct material and the direct labor, then I'm not going to be charging the right amount because I'm not accounting for my indirect costs. And those indirect costs is what we're talking about here when we're talking about manufacturing overhead. Okay? Again, a lot of terms I'm throwing at you. It'll make more sense as we try to work through a spreadsheet and or a flow chart. So I think that's what I have next. Manufacturing overhead. You guys can look through this. Okay, direct inventoriable product costs. I'll go ahead and hit it. Inventoriable product costs. Okay, meaning those finished together. That's our inventoriable product cost. So those things that we've put in inventory. Now, if we've got all three of these together, we know what our inventoriable cost is. And that gets back to how do we calculate what one of those items cost us? Okay. So manufacturing overhead, and I hit on this a little bit on the earlier slide. It doesn't cost selling general administrative functions. Okay. And that's the reason I was telling you that most manufacturing companies will pull the rent for the building and the utilities for the building out of the SG&A and they account for it in the manufacturing, because you got to pay the rent and you got to pay the utilities in order to be able to manufacture. So it's part of the overhead cost for manufacturing. Okay. Now, the lady I was telling you about that does the payroll, a lot of times that's an iffy one. Sometimes that one will be put into manufacturing costs. Sometimes that one will be left in the SG&A. More times than not, that one will be left in the SG&A because it is an expense that we have to account for, but she really doesn't have anything specifically to do with the manufacturing process. Where my expense as the plant manager, on the other hand, I was directly involved in the manufacturing process. So my payroll went to indirect and her payroll went to SG&A. Okay. Indirect materials. Okay, there are some materials that we have that we can't charge directly to an item. And what I'll go to now instead of the machine shop is I'll go to a wood shop. Here's a good example. If you're working in a wood shop and you're making rockers or kitchen tables or whatever, a lot of times when you buy in a place like that, you're not going to buy little bitty bottles of glue where you know it's going to take one bottle of glue to make this table. Be able to apply that, when you're working on the table. If you're going to buy it in bulk, being able to figure out how much is going to go to make the one table kind of difficult. Okay, so that bulk material of glue or bulk material stain, you may buy the stain again in a 5-gallon bucket, but that 5-gallon bucket may be able to stain 300 tables. So you're not charging that 5-gallon bucket against one table. It becomes an indirect material. You still have to charge it. It still has to be part of your calculation, but you're not charging against that one individual table. Does that make sense? And things that fall into that category is things that you buy in bulk, like glue or stain or nails. Most of the time when people buy nails, they're not buying, exactly the amount of nails they need to make one table. They're buying enough nails, they're buying the nails by the pound. Or pounds, plural. Okay. So enough for that. Other manufacturing overhead, and we kind of hit on this a little bit. Maintenance guys, repair guys, utilities, rent, property taxes, depreciation. Okay, let's talk about depreciation. So let's go back to the furniture making company. If I buy a saw that is a $7,000 saw, it's a big, honking saw, and it cuts massive amounts of wood, and this thing cost me $7,000. Okay. typically what happens when we buy something like that is instead of charging that $7,000 all at one time, that goes on to the company 7 years, we do not have, that's no longer an asset as far as on our books. Okay. So that depreciation has to be accounted for in our manufacturing overhead as well. So the way we typically do that is we'll look at this. When you're looking at depreciation, and this is going to come into your homework, when you're looking at depreciation, if the depreciation on the item is something specifically attributable to the manufacturing process, like the depreciation on the saw in a company that makes furniture, that you got to have the saw in order to cut the wood to make the furniture, right? So you can attribute that directly to the manufacturing process. So that depreciation we would have to account for. However, if you're looking at the depreciation on a delivery truck, we're not going to count that in our manufacturing costs. And the reason for that is the delivery truck is after the furniture is done and becomes that slide we looked at earlier where it says inventoriable product costs. Okay. That piece of furniture is done and it's in the inventory. The delivery truck happens after it goes into inventory. We pull it out of inventory, we sell it, pull it out of inventory, put it on the truck and deliver it. Well, you don't need that truck in order to manufacture that piece of equipment. You need the truck in order to sell it. Okay, so the depreciation on that truck would go into your SG&A, sales and general expenses, because you still have to account for the depreciation on that truck. It's just not part of the manufacturing process. Does that make sense?
Yep.
Go ahead. Did you have a question?
We just said yes. It makes sense.
Okay. I thought maybe you had a question. Okay, so.
We can't hear you.
You can't hear me?
Now we can. It cuts out a little bit.
Yeah.
Huh. I haven't had that problem before, so I'll have to check into that. Okay, so let's look back at the different types of companies that we've talked about today. All right, so we've got a service company. For the most part, when we're talking service company, there's no inventory, but they do have period costs. They've got salaries for the people doing the service. They may have depreciation. They may have utilities. They may have advertising. Think of Verizon at this point, okay? So all of their expenses, their advertising, their salaries, their insurance, all of their expenses in a service company is considered a period cost, okay? In a merchandising company, now we've got inventory. So our purchases plus our freight in. Remember, when you're talking merchandising and stuff, you have to account for the cost of shipping to get the stuff to you. You don't count, if you're shipping stuff out, you don't count that in your cost of goods sold, because when you're shipping it out, you've sold it, it's going out, that's a different expense. The freight in, however, is part of your expense for the goods that you're selling, okay? And again, a merchandising company pretty much deals all in period costs, okay? Salaries, depreciation. Manufacturing companies, you've got direct material, direct labor, manufacturing overhead, okay? Their period costs are those things that get charged out each period. There's their office salaries, their depreciation, utilities, okay? You don't have your manufacturing cost involved there. So let's look at a balance sheet, an income statement. Okay. So materials purchased goes into your material inventory. Now this is an income statement balance sheet. So the materials you purchase goes into your material inventory. Your direct labor and your manufacturing overhead is part of your work in progress. You're finished, and then that moves to finished goods inventory. So remember that slide where we saw the pieces of wood and we saw the labor guy there? This is another look at that. Okay. When we sell it, it goes to cost of goods sold. So materials, your labor and your overhead goes into this piece to get you this piece. So this plus this equals this. When we sell it, it then goes to cost of goods sold. But until we sell it, it's an inventoriable cost. Okay. So on our balance sheet statement, income statement is sales minus cost of goods sold minus our operating expense. Operating expense is that SG&A stuff, okay? Equals our operating income, our period cost. And if you recall, so those period costs that you saw on the slide before, back here, all of these things here, depending on which kind of company we're talking about, okay? When we get here, so our sales minus our cost of goods sold minus our operating expense gives us our operating income. Now, if you guys recall back to that spreadsheet we did, it said remember we had the 128,000 minus the 64,000 gave us the 64 income and operating income are essentially the same. They're synonymous. Okay. You guys are going to find that as we're going through this class, the terminology depends on who puts it together as to what the terms are. Now, you may see an income statement that has operating income and then later down it has net income. In that case, they're breaking it down. They're breaking down net income into operating income and then your final net income. In this case, for the simple process of what we're doing today, net income and operating income are the same. And 98% of the time they will be the same. And again, it all goes back to who puts the books together and the terms that they choose to use. So, a cost of goods manufactured. This is our beginning inventory. What did we have in the process at the beginning of that month? We're going to add to that, or we're going to add our beginning direct material inventory. So this is stuff that we're working on. This is stuff that we have as far as inventory, direct materials, raw materials sitting out there that we haven't started working on yet. Does that make sense? This is stuff we're working on in the process of production. This is stuff that's raw material that's sitting outside. We haven't started working with it yet, but we have it on hand. So if we take this raw material and we add to it any new raw materials we get, our ending direct material inventory. So if we add this and this together, this is ending direct material, excuse me. This is how much we have left over. So to get our direct materials used, we have to add what now, again, in spreadsheets, you guys are going to see this less listed two different ways. Sometimes you'll see in a parentheses around it. Sometimes you'll see a minus sign in front of it. Okay? Just understand, anytime you see a parentheses around it, you're subtracting. Okay?
Okay.
So this plus this minus this is going to give you your direct materials. So if you know what your direct materials is, and you know what your direct labor is, and you know what your direct or what your manufacturing overhead is, your total manufacturing cost incurred during the year is going to be these added together. Okay. Your total manufacturing cost to account for is going to be these that got added together plus this, less what you have left over that you're still working on, gives you your total cost of goods manufactured. And you're like, huh? Trust me, I am too sometimes when I look at this stuff. Let's see if we can make it make a little more sense. Our beginning work in progress inventory plus our direct materials used. Remember that was what was our raw material? How much raw material we buy? How much raw material is left over? So beginning plus purchase minus leftover gives us how much material we use. So our beginning work in progress plus our materials used plus our direct labor plus our manufacturing overhead gives us our total manufacturing cost. What did we start with? Manufacturing cost minus our work in progress, our ending work in progress equals our total cost of good manufactured. Does that help any more than the last slide?
Yep.
Okay. Just remember when you're doing your homework, these slides are available to you, and I will show you. Do you guys know how to find the slides?
Yes.
Okay. I'll show you in a minute because I saw a couple of no's, so I'll show you in a minute how to find these slides. I make my slides available to everybody. Not all the professors do, but I make my slides available to everybody. Okay. Okay, so let's look at it in a spreadsheet. This is a short, simple exercise, okay? You guys can look at this. This is one of those nice to know slides, but okay. So our beginning work in progress inventory was $6,000 worth of stuff that was being worked on, okay? We added $15,000 worth of direct material, okay? That's the beginning raw material plus what we purchased minus what was left over. So this is the material that we actually used this month. We had $7,000 worth of labor and we had $18,000 worth of overhead. So if we add all of these up, what we began with, how much material did we use? How much labor did we use? How much manufacturing did we use? We get our total manufacturing cost incurred for the year. Hang on. Total manufacturing cost incurred for the year is these three added together. Okay. Total that we have to account for. This is what we added for the year, but we added towards the $46,000. Our work in progress inventory at the end was $3,000. So our total manufacturing cost for the year was $43,000. That makes sense? Okay. Okay. I'm going to go through the ethical part of this fairly quickly. I'm not going to beat you guys up on about it. I think there is a question on the homework assignment about it, but okay. So Institutes of Management, IMA, develops standards, okay? Competencies, we need to be competent in what we're doing. Confidentiality, we have to hold both our purchasers and our suppliers' information confidential. We have to operate with integrity and objectivity, okay? That's boom, boom, boom. Pretty straightforward, okay? We just went through all of those slides, okay? Now what I'm going to do is show you how we want to do the homework. Okay. So I'm going to close this. Stop sharing for just a minute. My computer's being slow today, y'all. Forgive me. Okay, now. Are you guys seeing cameras?
Let's see, black screen.
What do you see right now?
Oh, we
We see you.
You just see me?
Your picture.
Well,
We
there's
see
words.
like the
Yeah, I like Calvary hashtag.
accounting for managers.
The home page.
Yeah.
Yeah.
You're seeing the Calvary homepage?
No.
Oh,
On Canvas
Sorry.
for the
sorry.
class.
Yeah.
We see like the home.
You see the Canvas class.
Yeah.
Okay, that's what you see the Canvas class. Okay, that's what I want to see. Okay, so Owen, so that you see how to get there. So when you get here, now you guys don't see these buttons. Okay, that's the teacher stuff that you don't see. But you should see a button on the side that says Files. So if you click on Files, and then you come down here and go to Slides. Chapter 1. So what we've done today is we went through the slides that I have set up for chapter 1. You click on those. So when you're doing your homework, if it's confusing you and you're having some questions, you just click on the chapter 1 slides. Okay? So that said, so in assignment 1, when you guys click on the modules for assignment 1, and Austin, if you would do that for me, and Owen, if you would, if you still got your computer open, do you guys see this when you click on module 1?
Yep, we see
Yeah.
it.
Okay, because you're probably, I don't know how well you're going to be able to see it on the screen, ladies, so you may want to do it on the computer. But when you click for assignment 1, and then when you click assignment 1, if you click this little download arrow next to it, it's going to and see the computer. Man, my computer's being slow today. There it goes. So you want to save it, you want to hit the download button and you want to save it to your computer and open it up, then click on it, then and open it up as an Excel file. I'm going to show you a couple of things that you need to do. So once you get it open as an Excel file, come up here and click this enable editing button at the top, so that then you can do stuff in here, okay? So this is your homework assignment for chapter 1. So you're going to look at this now. In the back of chapter 1, you're going to find S1-1. It's going to be in the back of chapter 1. This is the problem, and I took it straight from the book. I will tell you, I need you to make sure that when you're doing the homework, you're doing it with the book, and that you look at the problem in the book, because I may have done a typo. I may have, sometimes when I'm typing, I may transpose a number. If I have transposed a number or if I've done a typo, go ahead and make the corrections on your spreadsheet and work it out as the book has it done. Okay, so did you guys all find S1-1 in the back of chapter 1? Okay. So it should read just exactly like this, okay? So now what you're going to do is you're going to come down here. There's a typo right there, 4. I got F-O-R-E. Okay. For each item listed below, tell me whether it's manufacturing or financial accounting. So let's do the first one together. Helps investors make investment decisions. So is a financial or a managerial account?
Financial.
Okay. You're just going to put this FA out there for financial accounting. Easy enough?
Yep.
Okay. You guys can see what I'm doing, right?
Yeah.
Okay. So, and then, so you're just going to go down and answer each one of those. Okay. And then for S1-4, well, now we're getting into a little bit of a spreadsheet. Okay. And again, you can refer back to the slides. You can refer back to the lecture. You can have, here's what I will tell you through the course of this class. Okay. I need all of you to look at me for just a second so I know that you're tracking with me. Okay. In this class, when you're doing your homework, when you're doing your other stuff, it's open books, open notes, open slides, open videos, and if you choose to, you can work together in study groups. Okay? When we get to taking the quiz, it's open book, open notes, open slides. It is not, I say again, it is not open buddy, meaning you can't work together on your quiz, and it's not open Google. Okay? The reality is I need to know what you know. That's the purpose for the quizzes. Okay? I will also tell you, and usually I say this right up front, but I will say it now. As long as you are trying in my class, it is impossible to fail. Okay? How's that for a professor? Okay?
That's nice.
Because I will tell you this, if you are struggling with trying to understand some of this, we can do a one-on-one Teams meeting, and now mind you, I have to do it in the evening, but if you're struggling getting through some of this, I will do a one-on-one Teams meeting with you if we need, and do some extra tutoring and get you through it. Okay? So, in the course of 5 years, I have had people fail this class. And it's just, they weren't turning in the homework, and they just flat weren't trying. Okay? But as long as you're trying, you will get through this class. Okay? So anyway, you're going to come down here and you're going to plug in the information. Now, have you got 1-4 open? S1-4? Okay. You see it gives you a little bit of a story problem there, right? It says Martin and Reynolds provides haircutting service. Okay. This is how much their haircutting expense is. This is what their rent is. This is your utilities. So what you have to do is figure out, where do you plug that information in down here? Okay. Well, I pretty much have given it to you down here. So it's just a matter of transferring this information down here. Okay. And you're going to get your net operating income. But then that's requirement 1. Requirement 2 is where you got to put some brain power to it. Using the information in the book and the information in the lecture and the information in the slides, you got to figure out what your process is to calculate how much it is as a cost per haircut. And I stress the word cost because 99% of the time, if you get it wrong, what you're going to give me is you're going to tell me how much you're charging for the haircut as opposed to what it costs you to do the haircut. Okay? So make sure you understand the difference in the cost of goods sold and how you calculate to get the cost for 1 unit. Okay? So let's look at 1-5. Well, you notice in 1-4, I give you a whole bunch of information in that spreadsheet, right? Where all you got to do is plug it in. Let's look at 1-5. You got to figure out what goes in that spreadsheet. Okay? But I'm kind of walking you through it step by step. Okay? So you got to figure out what, now here's something I do need to show you. I don't think it takes place in this one. You're having to put stuff there. Let me show you how to put an extra line in that spreadsheet. So let's say like right here, you need an extra line right there. So if you click on the number out here on the left-hand side, and then you right-click, you can go up here and click Insert, and watch what happens. You notice that that thing just grew, it got one extra line bigger? Okay. Let's say you're doing it and you need to add 2 or 3 lines. You just do that however many times you need to in order to get the number of lines you need. Now, the other thing you need to look at is if you look in there, now in 77, there's a whole bunch of little break lines, okay? So the way you get that, see how this is one solid box, but this is a whole bunch of small boxes? The way you make these whole bunch of small boxes into one big box is you come down here and you click in the first box, and then you click again and hold it until you hit all 5 of those boxes. And then you come up to the top and you hit merge cells. Now, you may not see that in your alignment cell depending on which format you have, but all you have to do is find the alignment stuff, and then you can find merge cells. Okay? So you merge that cell, and then you come over here and you click these 2 and you merge that cell, and you do it again for any of them that you need to merge. Okay? Everybody got that?
Yeah.
Okay. So these are your short, small exercises, and what we're building towards is the bigger problem at the bottom. Okay, and every homework assignment is going to do that. It's going to give you shorter, small exercises that builds towards a bigger problem at the end. Right? The other thing I need to show you, now this one is now I'm going to go back to module 2. And I'm going to open that assignment. And hopefully it'll open a little, yeah, opened a little faster that time. Okay, now look up, or look on your screen, actually look up because you guys didn't go to, look up on the screen and see at the bottom of the spreadsheet, okay, you've got a problem and you got exercises. So this one, there's enough exercises that I have an exercise tab at the bottom. So you're going to do the shorter, small exercises. And then you got to click on the problem to get to the bigger problem. Okay. So just make sure, and I think that's only in the first 2 or 3 weeks that happens, where you'll have a couple of tabs at the bottom. Okay. So when you get to that point, just make sure you look at the bottom. And if there's multiple tabs down there, now you may get to one where there's multiple tabs and there's nothing on that second tab. If that's the case, don't worry about it. Okay? Any questions about the homework? Okay. So here's what I will tell you. Good luck. Like I said, ladies, if you guys want to work in a group to try to do this, that's great. Okay? Owen, obviously, you're kind of on your own out there. Again, if you guys have trouble while you're doing the homework and you want some help, just shoot me an email and we'll see if we can set up some time in the evening one week or one night in the week and try to do a Teams meeting one-on-one, and I'll get you through it. Okay?
Yeah, I actually have a question.
What's that?
So I just opened the first assignment and it's not letting me edit it. I clicked enable editing, but since I don't actually have Microsoft Word kind of stuff, it won't let me do it.
I think it's good. Weren't you the one that sent me the email about the pretest? Okay.
Yeah, I was trying to figure it out last night.
Oh, and you're going to need to contact our IT department.
Yeah.
Okay. Because you're working on an Apple machine, aren't you?
No, it's actually Asus. I'm not sure why I'm actually having that problem.
Okay.
But
Ladies, are any of you working on Apple?
Yeah. Yes.
Okay. Do you have Microsoft Office loaded onto your computers?
Yes.
Yes.
Okay. The reason I say that is this: if you're working on Apple, because what Apple tries to do is save it as Apple Pages instead of Excel, and Canvas, and this is true for all of your classes. Canvas does not read the Apple OS stuff. So if you're trying to turn in a text document or an Excel document and you've done it in an Apple product, it won't work. Canvas can't read it. So when you're doing your homework for Calvary University, you need to do it in a Microsoft Office product. So Owen, what you're going to need to do is contact the IT department, Daniel or Aaron, the third one. Who's the third one, ladies? Matt. Okay, Matt. I couldn't remember Matt's first name. So you contact the IT department, talk to one of the three of them, and they can walk you through how to go onto the Calvary website and download Microsoft Office onto your computer. Okay? And then you'll be able to open it and edit it and do what you need to do. Okay? Ladies, I will tell you, and for those watching the recording, usually I ask everybody to have done the pre-test prior to the first day of class, but I'm also usually around and I get a chance to talk with the students in advance. So I will class. However, you will get extra credit. So if you have not done the pre-test yet, you can still go ahead and do it. I won't cut that off until Sunday evening. Okay. So you got between now and actually it'll probably be Monday morning because I'm not going to be up at midnight Sunday night to turn it off. So you got between now and about 8 o'clock Monday morning to finish that pre-test. If you want, I think I got it set up to give you 15 extra credit points towards the class. Okay, and then at the end of the class, it's set up to do the same thing. You're going to get the same test. It'll be the same questions, they'll be all in a different order. But I ask you to take the pre-test and the post-test, because what that does is, taking the pre-test, it kind of gives me an idea where all of you are as far as kind of understanding accounting. And then when you take the post-test, that's kind of the way I grade myself, in seeing how many of you do better on the post-test than you did on the pre-test. Okay, so for the 4 of you, and then anybody that's watching the video, the pre-test will stay open until Monday morning. So if you want those extra credit points, please do that. And I have enjoyed this. You guys can count on the fact that class is probably going to end about 10:30 most mornings. 10:30. I very rarely go all the way up to 11 o'clock. Usually it's 10:30, 10:40, and we're done. Okay. It really depends on how many questions you guys have through the course of the class. And I encourage you, if you have questions, stop me and ask, because you may not be the only person that has that question. So if you have a question, stop me and ask, and we'll park on it for a little bit and make sure you guys understand what we're doing. Okay? Other than that, if you guys don't have any questions, we will cut you loose. And stop the recording.